I'm about to tell you something that will shock your financial advisor and probably make you uncomfortable, but it could be the most profitable advice you'll ever receive. There are three specific debts that you should stop making payments on immediately and redirect that money toward wealth building strategies that will make you significantly richer over the long term. This isn't about defaulting on your obligations or destroying your credit. This is about understanding the mathematics of money and making strategic decisions that optimize your wealth building potential rather than following conventional wisdom that keeps you financially trapped for decades. The financial services industry wants you to be a good little debt payer who sends them checks every month for 30 years while they get rich off your interest payments. But wealthy people think completely differently about debt obligations, and they structure their finances to maximize their returns rather than maximize their lenders' profits. What I'm going to share with you represents a fundamental shift from consumer thinking to investor thinking. Consumers focus on paying off debts and feeling responsible. Investors focus on deploying capital where it generates the highest risk-adjusted returns, even if that means maintaining certain debt obligations indefinitely. If you're ready to start thinking like a wealthy person instead of a consumer, if you want to understand how to use the financial system to your advantage instead of letting it use you, then subscribe to this channel right now and prepare to completely change your approach to debt and wealth building. The first debt you should stop paying immediately is your mortgage, assuming you have a fixed-rate mortgage below 5% interest. I know this sounds crazy because home ownership and mortgage payoff have been drilled into your head as essential components of financial responsibility. But the mathematics tell a completely different story. Here's the reality that mortgage lenders don't want you to understand. Your mortgage is probably the cheapest money you'll ever have access to in your lifetime. Banks are essentially lending you hundreds of thousands of dollars at interest rates that are often below inflation rates, especially when you factor in the tax deductibility of mortgage interest. Instead of making extra mortgage payments, take every dollar you would have used for early payoff and invest it in assets that generate higher returns than your mortgage interest rate. If your mortgage is at 4% and you can generate 8% returns through dividend-paying stocks or real estate investment trusts, you're making 4% annually on money that isn't even yours. But the advantage goes far beyond just the interest rate differential. Mortgages are typically the largest amount of leverage that middle-class people can access. When you pay off your mortgage early, you're giving up this leverage and limiting your wealth building to only the money you can save from your income. Let me show you the mathematical reality with concrete numbers. Suppose you have a $300,000 mortgage at 4% with 20 years remaining, and you're considering using a $300,000 inheritance to pay it off. The conventional wisdom says pay off the mortgage and be debt-free. But here's what happens if you invest that $300,000 instead. At 8% annual returns, that money grows to approximately $1.5 million over 20 years. Meanwhile, you continue making your regular mortgage payments totaling about $450,000 over the same period. Your net position is $1.5 million in investments minus the $300,000 remaining mortgage balance, leaving you with $1.2 million in net worth. Compare that to the debt-free approach where you have just your home worth perhaps $600,000 after appreciation. The investment approach leaves you with twice as much wealth while maintaining the flexibility and liquidity that stock investments provide. Plus, you've benefited from 20 years of tax-deductible mortgage interest that reduced your effective borrowing costs below the stated rate. But the mortgage payoff mistake goes beyond just opportunity cost. When you pay off your mortgage, you convert a liquid, diversified investment portfolio into an illiquid, concentrated real estate position. This increases your risk because you're putting all your wealth into one asset in one location. Real estate can decline in value, neighborhoods can deteriorate, local economies can collapse, natural disasters can occur. When your wealth is concentrated in your home, you have no protection against these risks. A diversified investment portfolio provides much better risk management while generating higher returns. The second debt you should stop paying immediately is low-interest student loans, particularly federal student loans, with interest rates below 5% and favorable repayment terms. The student loan payoff industry has convinced millions of people to aggressively eliminate student debt without considering the opportunity cost or the unique benefits of federal student loans. Federal student loans often include benefits that make them mathematically advantageous to maintain rather than eliminate. Interest rate subsidies, income-based repayment options, potential forgiveness programs, and deferment possibilities during financial hardship all provide value that exceeds the stated interest rate. More importantly, student loans are typically unsecured debt at interest rates that are below what most people can earn through basic investment strategies. Instead of aggressively paying off student loans at 4%, invest that money in broad market index funds that have historically returned 7 to 10% annually. The emotional appeal of being free from student loan debt prevents people from making optimal financial decisions. They feel burdened by the debt and want to eliminate it quickly, even though maintaining the debt while investing provides superior mathematical outcomes. Young professionals often make the mistake of living like graduate students for years after finishing school, using all their extra income to eliminate student debt instead of building wealth. This approach costs them the most valuable asset they have, which is time for compound investment growth. A 25-year-old who invests $2,000 annually for 40 years will accumulate significantly more wealth than someone who spends 5 years aggressively paying off student loans and then begins investing the same amount. The early years of compound growth are the most valuable because they have the longest time to multiply. Student loan payments are also typically tax deductible up to certain income limits, which reduces the effective cost of the debt below the stated interest rate. When you combine tax deductibility with investment returns that exceed the loan rate, maintaining student debt becomes financially advantageous. The third debt you should stop paying immediately is low-interest business debt that's secured by appreciating assets or generating cash flow that exceeds the debt service. Many small business owners become obsessed with paying off business loans without understanding that business debt can be the most valuable form of leverage available. Business debt allows you to control larger revenue-generating assets with smaller amounts of capital while preserving your personal liquidity for other opportunities. When business cash flow covers debt service and generates additional profits, the debt essentially pays for itself while building equity value. Equipment financing, working capital loans, and expansion debt all provide leverage that can multiply business returns dramatically. A business that generates 20% returns on invested capital can use debt at 6% to amplify those returns across a much larger capital base. Let me finish explaining why business debt elimination is a massive mistake, then show you exactly where to deploy the money you're no longer using for debt payments, because understanding which debts to stop paying is only half the strategy. The other half is maximizing the returns on that redirected capital. Business debt is often the cheapest capital a small business owner can access, especially compared to equity financing or personal investment. When you pay off business debt early, you're essentially choosing the most expensive form of business financing, which is your own after-tax dollars, instead of the cheapest form, which is tax-deductible business debt. Here's a concrete example. You have a $100,000 equipment loan at 5% interest with 5 years remaining. Paying it off early requires $100,000 of your personal capital that you've already paid taxes on. Keeping the loan means continuing $5,000 annually in tax-deductible interest payments while preserving your $100,000 for higher return opportunities. That preserved capital could generate $15,000 to $20,000 annually through business expansion, real estate investment, or stock market returns. Even after paying the $5,000 in loan interest, you're ahead by $10,000 to $15,000 per year while maintaining business leverage and cash flow flexibility. The psychological trap that destroys many entrepreneurs is confusing personal debt with business debt. Personal debt for consumption should generally be eliminated quickly, but business debt that generates returns exceeding its cost should be maintained indefinitely. The goal is optimizing capital efficiency, not eliminating all debt regardless of its productivity. Now let me tell you exactly where to deploy the money you're no longer using for extra debt payments on these three categories. This deployment strategy is crucial because simply stopping debt payments without alternative investment creates no wealth building benefit. The first deployment strategy is dividend growth investing, focused on companies that raise their dividends consistently over long periods. Instead of making extra mortgage payments, invest that money monthly into dividend aristocrats that have increased their dividends for 25 consecutive years or more. These companies provide current income that often exceeds mortgage interest rates while growing that income annually through dividend increases. Companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble have raised dividends for decades while providing total returns that significantly exceed typical mortgage rates. The power of dividend growth investing becomes clear over long time horizons. A stock that starts with a 3% dividend yield and grows that dividend by 7% annually will yield over 6% on your original investment after 10 years and over 12% after 20 years. Meanwhile, your mortgage payment remains constant. This dividend growth approach provides inflation protection that mortgage payoff can't match. As inflation increases costs throughout the economy, dividend-paying companies raise their prices and dividends accordingly. Your investment income grows while your fixed-rate mortgage payment becomes cheaper in inflation-adjusted terms. The second deployment strategy is real estate investment trust investing that provides exposure to professional real estate management without the complications of direct property ownership. Instead of paying off student loans, invest that money in REIT index funds that typically yield 4 to 6% while providing inflation protection through rent increases. REITs offer diversification across property types and geographic regions that individual real estate ownership can't match. A REIT portfolio might include residential apartments, commercial office buildings, industrial warehouses, data centers, and healthcare facilities across dozens of markets. This diversification reduces risk while providing steady income and long-term appreciation potential. REITs are required to distribute 90% of their income to shareholders, creating reliable income streams that often exceed student loan interest rates while building long-term wealth through property appreciation. The third deployment strategy is business reinvestment for entrepreneurs who should be using debt payoff money to expand their operations rather than eliminating productive leverage. Business expansion typically generates much higher returns than the cost of business debt while building enterprise value that can eventually be sold for significant multiples. Instead of paying off equipment loans or working capital debt, invest in marketing that generates new customers, technology that improves efficiency, inventory that supports sales growth, or additional equipment that increases production capacity. These investments often generate returns of 20 to 50% annually, far exceeding typical business debt costs. Business reinvestment also provides tax advantages because most expansion costs are deductible business expenses, reducing your taxable income while building future cash flow and enterprise value. Compare this to debt payoff using after-tax personal income that provides no tax benefits or wealth-building potential. The key principle underlying all three deployment strategies is optimizing return on capital rather than minimizing debt obligations. Wealthy people always deploy capital where it generates the highest risk-adjusted returns, even if that means maintaining debt obligations that less sophisticated investors try to eliminate. But successful implementation requires discipline to actually invest the money rather than spending it on lifestyle upgrades. Many people stop making extra debt payments, but then increase their consumption instead of investing the difference. This eliminates the wealth-building benefits while maintaining the debt obligations. Set up automatic investment transfers that redirect debt payment money into investment accounts before you can spend it on other things. Treat your investment contributions with the same discipline you would have applied to debt payments, because the investment contributions are actually more important for your long-term financial success. The risk management aspects of this strategy also require attention. Maintain adequate emergency reserves before implementing these investment strategies, and ensure that your regular debt payments remain affordable, even if investment returns temporarily decline. The timeline for seeing benefits from this approach varies depending on market conditions and specific investments, but the mathematical advantages compound over time. The longer you maintain productive debt while investing instead of paying it off, the larger the wealth differential becomes compared to the debt elimination approach. Tax optimization becomes increasingly important as your investment accounts grow. Use tax-advantaged accounts like IRAs and 401k plans when possible, and consider tax-efficient investment vehicles that minimize current tax obligations while maximizing long-term after-tax returns. The psychological adjustment to this strategy often requires time because it goes against deeply ingrained beliefs about debt elimination. Start small if necessary, redirecting modest amounts from debt payments to investments until you become comfortable with the approach and see the mathematical benefits developing. Now let me give you the exact implementation plan for stopping these debt payments and redirecting that money toward wealth building, because knowing the strategy is worthless unless you can execute it correctly without making costly mistakes. The first step is conducting a debt audit to identify which of your current debts qualify for this strategy. Only stop paying debts that meet specific criteria: fixed interest rates below 5%, tax-deductible interest, and terms that allow you to maintain the debt indefinitely without balloon payments or resets. For mortgages, verify that you have a fixed rate below 5% with at least 10 years remaining. Adjustable rate mortgages or loans that reset don't qualify because interest rate risk could eliminate the mathematical advantages. Short-term mortgages with only a few years remaining provide limited benefit because the compound growth period is too brief. For student loans, focus on federal loans with fixed rates below 5% and favorable repayment terms. Private student loans with variable rates or harsh default consequences should typically be eliminated quickly. Federal loans with income-based repayment options and potential forgiveness benefits often qualify for this strategy. For business debt, ensure that the debt is secured by appreciating assets or generates cash flow that exceeds debt service. Unsecured business debt or loans for depreciating assets should generally be paid off quickly. The business must generate sufficient cash flow to service the debt without requiring personal guarantees or risking business operations. The second step is calculating the exact amount you'll redirect from debt payments to investments. This includes any extra principal payments you've been making, plus the difference between current payments and minimum required payments where applicable. Set up automatic investment accounts that receive these redirected payments on the same schedule you were using for debt payments. If you were making extra mortgage payments monthly, set up monthly investments into dividend growth stocks. If you were making quarterly student loan payments above minimums, set up quarterly REIT investments. The automation is crucial because it prevents you from spending the money on consumption and ensures consistent investment discipline. Treat these investment contributions with the same priority you gave to debt payments because they're actually more important for your long-term wealth building. The third step is selecting specific investments that match your risk tolerance and time horizon while providing returns that exceed your debt costs. Conservative investors should focus on dividend aristocrat index funds and blue-chip individual stocks with long dividend growth histories. Moderate risk investors can add REIT index funds and international dividend stocks to capture broader market opportunities while maintaining focus on income generation. Aggressive investors might include growth stocks and emerging market investments, but always maintain a foundation of income-producing assets. The key principle is ensuring that your investment returns consistently exceed your debt costs after accounting for taxes and fees. This margin of safety protects against temporary market declines while ensuring long-term wealth-building advantages. Now let me address the most common objections to this strategy, because understanding these concerns will help you maintain discipline when friends, family, or financial advisors question your approach. The first objection is that debt elimination provides guaranteed savings equal to the interest rate, while investments provide uncertain returns. This objection ignores the historical evidence that diversified stock and real estate investments have provided superior returns to low-interest debt over virtually all long-term periods. The guarantee of debt payoff is actually an opportunity cost guarantee. You're guaranteed to lose the potential returns you could have earned by investing instead of paying off low-cost debt. This guaranteed loss often exceeds the temporary volatility risk of appropriate investments. The second objection is that being debt-free provides peace of mind that investing cannot match. This psychological benefit is real but expensive. Calculate the cost of this peace of mind by comparing the wealth-building potential of both approaches over your investment timeline. For many people, the peace of mind from debt freedom costs hundreds of thousands or even millions of dollars over their lifetimes. Understanding this cost helps you decide whether the psychological benefits justify the financial sacrifice. The third objection is that this strategy increases risk by maintaining debt while investing in volatile assets. Actually, this strategy often reduces risk by creating diversification and liquidity that debt payoff cannot provide. A diversified investment portfolio with maintained mortgage debt often has lower total risk than concentrated home equity with no liquid investments. The fourth objection is that tax law changes could eliminate the benefits of mortgage interest deductions or change the tax treatment of investments. While tax laws do change, the fundamental mathematics of leveraging low-cost debt to acquire appreciating assets remain valid regardless of specific tax provisions. Here's your specific implementation timeline. Month 1, complete your debt audit and identify qualifying debts. Month 2, set up investment accounts and automatic transfer systems. Month 3, begin redirecting debt payments to investments while maintaining all minimum required debt payments. Monitor your progress quarterly by comparing your investment account growth to what your debt balances would have been under the elimination approach. Track both the absolute wealth difference and the cash flow improvements from dividend and interest income. The most important success factor is maintaining long-term perspective during temporary market volatility. Investment accounts will fluctuate in value, sometimes dramatically, but the long-term mathematics favor this approach over debt elimination for qualified debt categories. Start small if you're uncomfortable with the full strategy. Redirect just extra principal payments to investments while continuing normal debt service. As you see the benefits developing and gain confidence in the approach, you can optimize further by refinancing to longer terms or lower rates that maximize the investment arbitrage opportunity. The compound effect of this strategy becomes more powerful over time as investment accounts grow and generate increasing income while debt balances remain stable or decline slowly. After 10 to 15 years, many people following this approach have investment income that exceeds their total debt service while maintaining substantial asset bases. If this strategy makes sense for your financial situation, take action immediately to begin the debt audit and account setup process. Every month you delay costs you potential investment returns that compound over time and can never be recovered. Subscribe to this channel for ongoing guidance about implementing investment strategies that optimize your wealth building potential. Share this video with anyone who's been programmed to eliminate all debt without considering opportunity costs and alternative approaches. Leave a comment below and tell me which of these 3 debt categories you're going to stop paying extra on and how much money you'll redirect to investments. The community of people who understand these strategies needs to support each other against conventional wisdom that keeps people financially trapped. Remember, the goal isn't to eliminate debt for its own sake. The goal is to optimize your financial resources to build maximum wealth over your lifetime. Sometimes that means maintaining productive debt while building investment portfolios that generate superior returns.